If you've been watching silver lately, you probably noticed something strange. Today, the price is bouncing hard. Silver is trading around $73 an ounce, up roughly 4 to 5% in a single day. Moves like that usually make headlines. But here's the part most people are missing. Despite today's rally, March has been absolutely brutal for silver. Even after this rebound, the metal is still on track for a roughly 22% monthly drop. That's one of the sharpest pullbacks silver has seen in years. And this wasn't just random volatility. Silver got caught in the middle of something much bigger, a major macro shift across global markets. And once you see what actually triggered the move, the entire sell-off starts to make a lot more sense. To understand what just happened in silver, we need to go back a few months. Because silver didn't fall from nowhere. It came after one of the most explosive rallies the metal has ever experienced. Throughout 2025, silver surged higher as supply tightened, retail demand exploded, and geopolitical tensions pushed investors toward hard assets. That momentum carried straight into 2026. Earlier this year, silver blasted past $100 per ounce. At one point in late January, prices even briefly touched around $121. That kind of move is extraordinary. But markets that rise that fast almost never stabilize quietly. Eventually, something changes. And when the narrative shifts, the reversal can be just as violent as the rally. That's exactly what happened in March. The biggest driver behind silver's correction actually had nothing to do with silver itself. The real catalyst was energy markets, specifically oil. March was dominated by rising geopolitical tensions around Iran and the Strait of Hormuz, one of the most important oil shipping routes in the world. As tensions escalated, oil prices surged. Brent crude climbed toward $118 per barrel. That spike changed something critical in the macro outlook: inflation expectations. Earlier this year, investors believed central banks, especially the Federal Reserve, were getting closer to cutting interest rates. But when oil prices surge, inflation tends to follow. Energy costs feed directly into transportation, manufacturing, and consumer prices. And suddenly markets had to rethink the entire interest rate outlook. If inflation starts rising again, central banks may not be able to cut rates after all. Markets reacted quickly to that possibility. This is where precious metals come into the story. Silver, just like gold, does not produce income. It doesn't pay interest. So when interest rates rise, or when investors expect them to rise, holding metals becomes less attractive compared to interest-bearing assets like bonds. That's called the opportunity cost of holding precious metals. And that pressure showed up across the entire metals complex in March. Gold itself is now heading toward its worst monthly decline since the financial crisis. But silver moved even more dramatically, which raises an obvious question. Why did silver fall so much harder? Silver isn't just a monetary metal. It's also an industrial metal. Roughly half of global silver demand comes from industrial uses: electronics, solar panels, manufacturing. That creates an unusual dynamic. When oil prices spike and inflation rises, markets start worrying about something else: economic growth. High energy prices can slow the global economy. Businesses face higher costs. Consumers spend less. Manufacturing slows, and when growth concerns appear, industrial metals often struggle. So silver suddenly faced two separate pressures at the same time: higher interest rate expectations and concerns about industrial demand. Gold mostly deals with the first issue. Silver deals with both. Over the years, I've noticed something interesting about silver markets. When macro conditions start getting complicated, silver tends to react first. There was another factor that made the sell-off even worse: positioning. By the time silver peaked earlier this year, the trade had become extremely crowded. Retail investors piled into the metal. Silver ETFs saw massive inflows. Futures markets showed extremely bullish positioning. When everyone is on the same side of a trade, it can work for a while. But once the narrative changes, the exit can get crowded very quickly. And that's exactly what happened. Earlier this year, silver experienced a one-day drop of more than 30%. One of the most dramatic moves in the market's history. Moves like that tend to shake out speculative investors. March looks like part of that position clearing process. Now, let's talk about the rebound. Why is silver suddenly jumping today? Part of the move appears to be tied to improving risk sentiment across global markets. Equity markets rebounded as investors grew slightly more optimistic that geopolitical tensions might stabilize. At the same time, precious metals received some safe haven demand during the session. But one strong day doesn't necessarily mean the correction is over. Markets often produce sharp rallies during sell-offs, especially when the prior decline was driven by forced liquidation, and silver has always been prone to those kinds of violent reversals. So where does silver go from here? The answer probably depends on something bigger than silver itself: oil prices. If oil stays elevated around $110 to $120 per barrel, inflation fears could remain high. That would keep pressure on interest rate expectations, and that environment tends to be difficult for precious metals. But if oil prices start falling, the entire macro story could flip again. Lower energy prices would ease inflation fears. That could push bond yields lower, and falling yields often support precious metals. We've seen that sequence play out many times before. Right now, 3 indicators will likely determine silver's next move. First, oil prices. Energy is the biggest macro driver at the moment. Second, bond yields. If yields start falling again, precious metals could regain momentum quickly. And third, global growth signals. Silver is extremely sensitive to manufacturing demand, so data from the global economy will matter. Silver's rally today definitely looks impressive, but the bigger story is the macro shift that triggered the sell-off in the first place. Oil shocked the inflation outlook, interest rate expectations changed, and one of the most crowded trades in the commodity market suddenly had to unwind. Now, the real question is this: was March the end of the silver boom? Or was it simply the kind of violent volatility that often happens right before the next major move higher?